This is a note that's real important for you, okay? Inversion fair value gaps, the highest form of precision, the ones that are really, really trustworthy, the ones that have the highest degree of working in your favor, depends on your understanding of what I taught you yesterday and what I'm building on here. Whereas we have an area that's smooth after 7 o'clock, so the 7 o'clock in the morning starts the AM session. So now you start hunting on the 15-minute time frame, the 5-minute time frame, and the 1-minute time frame. You're hunting relative equal highs and lows to form after 7 o'clock. Well, we have that here. You may not have had the experience to anticipate this run up. That's fine. You don't need it. You don't need it. Remember when I first taught breakers? I taught that on baby pips back in 2011. Yeah, I think it was 2011. If it wasn't, it was 2012. The idea of waiting for a stop run and then wait for the market to come back down in to the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt, and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now remember what I taught you. A down close candle that is a fair value gap is a SIBI. A up close candle right here, this is the opposite, which is a BISI. BISI. Buy side imbalance, sell side inefficiency. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. This fair value gap here, if you don't understand what you're looking for and you don't have the element of time, Dave, and you trade back down into this fair value gap, you might be lulled into thinking, well, wow, this is an opportunity for me to take one of those ICT fair value gap buys and go long. And then it's to your detriment that it reverses and collapses on you. Understanding that it's 7 o'clock, post 7 o'clock, we have relative equal highs. It rallies after, remember the new week opening gap I talked about yesterday? You're going to discover, Caleb, that your model is going to be gravitating towards those new week opening gaps. That's your model. You're going to be trading in that direction. But before we get to that, you have to be able to look at small fluctuations around segments of time that will have a repeating phenomenon, that they all look very similar to one another. It's a fractal, okay? But the fractal element is only repeating and verifiable on the time frames I'm teaching you to focus on right now. We're not going anything higher than the 15-minute time frame. But this buy side imbalance, sell side inefficiency, that fair value gap, is going to have a role reversal where everyone else that thinks they understand it because they've been introduced to it lightly, that is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. Now, I'm going to slow things down here because I already know some of your heads are spinning. You're like, dude, you said this is going to be easy. You're not complicated. What I just said is not complicated. You have to look at these specific times of the day. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs, or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's given you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this. But my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. I want that. That's the one I want. Everybody else might be trading down here, and they might get a fill right there. And they won't be comfortable trading into this high here or right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there, that right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. It's right there. And then this becomes a selling point. And now what do you have at this point? You have this low and this low. And what time of day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So let me slow you down because you're getting a little panicked, I'm sure. This is too much information, my head's spinning, ICT. All you're doing is you're looking for areas where they can stop people out and go the other direction. That's essentially all you're doing. And you're looking for little periods of price action where obvious highs can be targeted, obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. That means things that we've been coloring here with the rectangles. Okay? Your eye will jump to them with experience. You'll see them more the more you do this. And because of that experience factor, you'll learn to filter out some of them because they've already been used several times. It doesn't mean that they won't be used again. It just means that the ones that are unfilled or left in a state of imbalance, like this portion of this gray box here, from this candlestick's high to that candlestick's low, there's a little bit of inefficiency. And graphically, it looks like this. That's the remaining portion that's inefficient, that little segment up there. It doesn't mean it can or needs to fill it right now. It's just that's the part that my eye goes to. But you still want to have the low, the midpoint, which is consequent encroachment, and the high. You want to have those levels all the time because they will refer to them. If the price is trading anywhere around this range here the rest of the day, watch and see how it uses it. It will use it again. So if you want to talk about support and resistance, these inefficiencies are the real support and resistance in price action. You'll see them, kiss them, turn on a dime, go right to the level, stop, turn around, the bodies of them stop. Like it's so precise. It goes without question. It's laughable for anyone to say there isn't an algorithm. These price engines, what are they referring to? Think about it. What are they referring to? If it's an algorithm, it has to refer to something it's happened in the past. So what I've done is I've created a language where you're either going to be reaching for old highs for the express purposes of taking out or engaging that liquidity that would be resting above it in the form of buy stops, or going below a low or equal lows for the express purposes of going down to engage the sell side liquidity or sell stops. Outside of that, what are we left with? Anything that's inefficient in terms of price action. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker, where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point, because it's going to trade right back up into that. And if you go back and look at your examples, maybe you've taken trades, whether it be live, demo, whatever, or maybe you've done some annotations in chart work and journaling, and you were focusing on studying on the breaker. Go back and see if this signature doesn't appear in some of them, and maybe some of the things that you would have taken as a trade there, or maybe you've taken and got stopped out. This was the factor that you didn't see it happening. And notice that this is the only buy side imbalance, sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs, until the narrative is likely to change bullish, your focus goes to only looking for sell side imbalances. That means a down close candle that has a segment with the previous candle's low, and the subsequent candle after it has a high that doesn't connect. And the only bridge between those 2 points is the down close candle in between. That's your fair value gap. And it's specifically a sell side imbalance, buy side inefficiency. And by having that, what that does, it removes the ambiguity. And it gives you a very specific process of saying, okay, I'm only focusing on these specific fair value gaps. I get that question a lot, even with private mentorship students. How did I pick that one? Why did I pick that one? Why didn't I pick this one over here? Well, that comes with experience. And it may seem like a cop-out to some of you that is straight asshats and you don't really want to take the honest truth. There's some things that you're going to have to get with experience.